As Fundstrat Global Advisors co-founder, head of research Tom Lee joins us here at Post 9 on a summer Friday. Tom, thanks for coming in.
Great to see you.
Was it last week? Was it difficult to keep your bearings in the midst of that crazy price action?
Without question, because the market had been whipsawed by data point to data point, as you guys were recapping. You know, the jobs report raised recession fears, big risk off. Then we got inflation this week, which was pretty tame, and I think markets suddenly went back to thinking about liquidity coming into markets. I think that the data dependence of the markets and the Fed is very tough for investors. And I think if you look ahead, I'd say we always know the summer is tough. Summer probably runs through October, but I don't think that anything's changed into year end, which should look pretty good.
But are you lower conviction now than you were 2 weeks ago?
No change in our conviction, but it is just recognizing August historically is a tough month for markets. I mean, one thing that maybe investors can be encouraged by is since 1928, the most common month for the summer low is August, and the most common week is the first week of August. So I think maybe the worst is behind us, but it doesn't mean we're straight up from here.
Right, and I guess the question is, I keep going back to, that moment in mid-July when we were at the highs. You were just shy of 5,700 on the S&P 500, and everything was a go. It was, the AI earnings path was kind of unquestioned. In addition to, general soft landing expectations, you kind of didn't have a lot of painful trade-offs to worry about in terms of policy or growth. Can we get back to something like that? I guess the idea, as you say, maybe summer lasts through October. Do you expect that we're going to have to continue to reset around these levels?
Yeah, I think if my best guess would be, it's still going to be a struggle, but we're climbing the escalator again. I think Jackson Hole is going to set a positive tone on balance, just because the evidence is growing. FOMC members want to be forward-looking, as you guys are pointing out. Data dependence is dangerous at turning points. And then we get the jobs report for August, which I think should reverse some of things that could be temporary. I mean, that's a guess, and if it is, then recession risk is sort of reduced. But now we have real rates are too high, and that means investors will be comfortable with cutting.
I'm thinking back to some of the notes you wrote after the last jobs number, and you looked at Hurricane Beryl and the number of companies in Texas that had no power for 2 weeks, and you do think August will be reassuring on the NFP print?
Yes. I mean, in some ways, the weekly claims is telling the story. We had a surge in claims, multi-month high, that have come down since then. And so even if someone says there was no effect from the hurricane, how do you explain claims really improving so much, especially in places like Texas? And, a million homes without power for 2 weeks, how could that not affect the local economy and the jobs market?
This rebound that we've gotten from the lows of early last week, initially, certainly until yesterday, it was back to the first half winners. It was a lot of the mega cap growth stocks, and the equal weight S&P really didn't have that much of a pullback, and it's closer to its highs. But small caps definitely got a flush, and yesterday they rallied big on that retail sales number. But it seems like that's still been a complicated attempt at a rotation.
That's right. They always say bottoms are tough and bottoms are a process, and small caps are really in the process of what we think is a multi-year bottom. And so conviction is not going to be as strong as things that have been working. I think most people's toolkit is to buy the triple Q, the NASDAQ or the AI names when they want to get back in the markets. But cutting rates at a time when small caps trade at 10 times forward PE, better earnings growth, and then a visible path to easing, I would say it still makes sense that the risk reward is in small caps.
And then, we had a miss on housing starts this morning. So it's funny, is the parts of the economy you thought you could rely on for a while, maybe are giving way as other ones maybe start to bottom. But what's your thought there in terms of the flow through to the rest of the economy?
I think housing, auto sales, and durable goods are essentially in recession. Mm-hmm. It makes sense because cost of money is so high. I mean, it's super expensive and hard to afford a home or to buy a car with these rates. These are also directly benefiting from Fed cuts because adjustable rate mortgages adjust, business loans adjust, auto loans, credit card, they're sensitive to short-term
builders
rates.
loans too. I mean,
yeah,
if you're building
that's
a house.
right. Cost of money for builders, yeah. And so I think these really benefit from an easing cycle, but a market that believes there's an easing cycle underway.
How many cuts you think we get this year?
I'm looking at consensus, which is somewhere between 4 and 5.
Before the end of the year?
Yes.
So about 100 basis points?
I think that's right, but it depends on where inflation prints the next couple months. But our base case is that we're on a glide path towards 2%. That's better than consensus. So I think 4 to 5 still makes sense.
And you've been, part of your thesis has been that elements of CPI have been falling, in your words, like a rock.
Yes.
I actually saw that phrase repeated in another desk note yesterday, so that's spreading. But are you as assured of that? And when you look at things like car insurance or some of the coincident costs of owning a vehicle, as you point out?
Yeah, I think one of the things that surprises us still is that two things are keeping inflation high on a weighted basis: shelter and auto insurance. Auto insurance adequacy is there now. If you look at the results from these auto insurers, they don't need to raise rates, so I think that's cooling, and that'll come in the second half. And for housing, rent is stabilizing, and I think housing is going to cool. It just needs to get to 3 to 4%, and then markets will be comfortable that we're back at 2. But median inflation rate is still 1%. That's below Fed's.
Well, I think as Greg Ipps said this week, rents are inertial. It takes time for those new rents to cycle in.
Yeah, that's right.
Alright guys, this is the part of the video where I'm going to break down the stocks that were mentioned in the CNBC clip. Today they talked about the Russell 2000 small caps, the S&P 500, and the NASDAQ. So we'll briefly break down those 3 ETFs. If this is your first video, the blue line is the 45-day moving average, and the green line is the 200-day moving average. So right off the bat, you can see the Russell 2000's been chopping sideways for about 6 months now, barely making any gains. And if we take it a step back, this is the weekly chart. The first time we were at this price level was January of 2021. So we spent 3.5 years in the Russell without making any gains from today's prices. That's pretty incredible. So that's what Tom Lee's talking about with the multi-year bottom. We had a very strong channel in 2022 and 2023 with very strong support and resistance levels. We're finally making our way to the top of that channel and making that resistance turn it into a support. We now have a double bottom on this resistance turn support, and we're back headed to the upside. So that is bullish for the Russell 2000. We also have the 45-day moving average breaking back above the 200-day moving average. That's a bullish cross. That is a long-term bullish cross. You can see the opposite happened back here when the 45-day moving average crossed below the 200-day moving average. That is extremely bearish, and we had a sell-off and we regained it almost instantly. Now that we've had the bullish cross, we've had multiple years of consolidation, we've had the PE ratios shrink on most of these stocks. Small caps are starting to look very bullish. On to the S&P 500, guys. We've had this ascending trend line here for months and months. We were watching it heavily when we broke down, and even down here on this Monday, I was saying, guys, if we somehow get back above this ascending trend line, the bull market is back on. And look at this crazy run we've had, almost straight up. This is what happens when retail panics out all at once and all the institutions buy it up. They buy it up so quick that you don't even have a chance to get back in, guys. That's why you want to play the long-term game, only invest in good quality stocks, and you want to be able to add when they go down. You don't want to be panicking out. Look at this move. It's unbelievable. Anybody that sold out, I almost guarantee did not get back in because they were waiting for lower and lower prices. We have now reclaimed the 45-day moving average. We've also reclaimed this ascending trend line. So this is extremely bullish for the S&P 500 from here, guys. This price action does not lie. It seems the Japanese carry trade was just a big, huge fake out. Also coming in the month of August, which we know is historically weak. So it's really not that big of a surprise. What is surprising is how fast we've shot back up. Also looking at the QQQs, the NASDAQ, we've had the same ascending trend line. We broke way below it, touched the 200-day moving average, bounced off of it nicely, and we've just slingshotted all the way back up. We have reclaimed the 45-day moving average and reclaimed this ascending trend line, guys. So we're looking extremely bullish on the NASDAQ and S&P 500 and Russell 2000. We are due for a sideways consolidation or a pullback. With a run like this, one is needed. But that does not mean that the run is over. We could just kind of chop around sideways for several days to a week, make this a very heavy support, show that we're reclaiming it, we're not going to go lower, and blast off to the upside, guys. This was one of the biggest, fastest shakeouts that I remember, and all you had to do was not panic on one day. This wasn't even a long, painful sell-off, guys. This happened in like 3 days. So as of right now, all 3 of these ETFs are looking extremely bullish. They have very nice support. They've rejected going lower. They've bounced off either the 45-day moving average or the 200-day moving average. We've reclaimed the ascending trend lines, and we're back to the upside, guys. This is a lot of data to suggest that that was a huge fake out and not a real downturn in the market. Notice nobody's talking about the Japanese carry trade anymore. They're not talking about recession fears. The only thing they're talking about is how fast this market came back and how off-size they were. This is why we invest for the long term. We invest in high quality stocks that we're not afraid for them to go lower. If they go lower, it's good for us because we get better and better prices on outstanding companies. And this is just another example. People were panicking out down here way at this 200-day moving average, and they've already missed out on almost 12%, guys. That's over 1 year's worth of gains in the last couple weeks. The market is very risky. It's very challenging. Make sure you're investing in stocks that you feel comfortable in and want to hold for the long term. I hope you guys enjoyed the video and the breakdown. If you did, smash that like button and subscribe, and I'll catch you in the next one. Peace.